let us look at leases. Okay, I hope you have got an idea about leases. Did you go through?
Yes.
Okay, so if you can explain, like, what is your idea?
Okay. So when a company is been leasing any of this machinery or anything to another other company, so the other company will not be showing the asset in their books. But it would be using it, but it will not be showing the asset in the books, and it will be showing only the revenues which it has earned through the asset. It will be booked. Only the rent or the amount which it will be paid to the that company only, it will be booked in the P&L. So it will not be showing a correct picture. When it comes to the balance sheet, the books of A, it will be like it will be having an asset value will be shown there, and the revenue also will be shown. When it comes to the B, which is the leasee, in his books, we will not have any asset, whereas he has a revenue. So I think the way we project the things, it is not correct. So what? Yeah. So what we will do in IFRS 16 regarding this leases is, we will be creating or recognizing an asset to the extent of whatever the asset being transferred, and to the same extent we will create a lease liability in the liability side regarding the asset which has been created. Regarding that is ROE related asset. For that, we will be charging a depreciation, which will be shown as a cost. And in the lease liability part, we will be amortizing it, like considering it as a loan. As a part of interest, we will be booking that also into the P&L. Instead of showing the rent, we will be showing the depreciation part and the interest part. So that even the asset portion is being recognized into our books, and the revenues which it is flowing from the asset, that also being recognized along with the cost of it.
Right. Good. Okay. Very good summary. So basically, the idea is, the idea of the standard is to recognize that there is an asset which the entity is controlling. Right.
Yes.
If you are controlling the asset, okay, then you should show in your balance sheet. That is the objective, like at a high level. Right, at a high level, if you are controlling an asset, you are using an asset, you are controlling an asset, then it should be shown in the balance sheet. Whether you own or not is not a criteria. Okay, so that is the objective of bringing IFRS 16. Earlier, we had an older standard. Okay, talking about lease. Okay, if I'm not wrong, it was IAS 17. Let me check. It was IAS 17 actually. Earlier, older standard was IAS 17, where they are not talking about control. They are talking about finance lease and operating lease. Okay, now there is no distinction between finance lease and operating lease. So the whole idea is, if you are controlling the asset, then you should show in the books of accounts, whether you taken it on lease or rent or whatever it is. Okay, point one. So if you have to show the asset, okay, that means because you are using the asset, you have to show the asset, right? So that the stakeholder understand that yes, you have an asset, and you are using that asset to generate the revenue. Okay, and it is when I'm controlling the asset, it is as if I've taken a loan and then
purchasing that asset. Yeah.
Taken a loan and then
buying the asset.
Right. So that is why you are recognizing a liability as well as a right of use assets.
Yeah.
Is liability and right of use assets. Right. So do you know like how the calculation and all works? Like, do you go through or did you understand the calculation part?
First, the present value, right, of the cash flows based on the rent.
Present value of lease payments. Okay. Yes. Generally, the definition is, Okay, they will say present value of basically fair value of the asset. Okay, something like that. But at a high level, present value of lease payment. Here also, you will recognize lease liability and right of use assets based on the present value of lease payments, considering any advance money paid. Okay, if you are paying, because when you're starting a lease, you will pay an advance amount, right? So if that is paid, then to that extent, lease liability will be lesser. Right of use assets will be higher. Okay, because if you paid any advance, that will get added as right of use asset. And from this liability, it will come down. Okay, so one is right of use assets, where you will charge depreciation over the
lease term,
over the useful life or lease term.
Yeah.
Okay. Whichever is lower generally.
Lower. Yeah.
Okay. Depreciation over the useful life or lease term, and it will follow IAS 16 basically.
Yeah, PP. Yeah.
Okay, like how you depreciate and subsequent expenditure, revaluation and all, like IAS 16. Okay. Lease liability you will follow basically IFRS 9 amortization accounting.
Yes.
You will follow amortization accounting. That means you will charge interest in the P&L. And liability will keep coming down year on year.
Yeah.
Okay, so this is at the high level. What I will want you to do is to understand the nitty-gritty, like basically, okay, for example, let me look at the material ones. So, do you have the material handy?
Yeah.
No, you have the book with you?
Yes.
Yeah, so if you can go to the lease chapter.
Okay,
it is what, chapter number 8.
Yeah.
So if you're there, like I think page number 158. So where they're talking about what is lease liability, like how do you measure the lease liability?
Okay.
Let me share the screen. So you can see my screen. I'm sharing here also. So, like liability is measured at the present value of the lease payments that have not yet been paid.
Okay.
Okay, that means you can pay advance also, right? Like, very simple. Practically, if I'm entering into an arrangement, I will have to pay something, right?
Yeah.
So that cannot be liability because I've already paid.
Okay.
Whatever I get to pay, present value of that. Okay, include the fixed payments, variable payments. Okay, any variable payments like later, depending upon, say, there could be an arrangement that if you use the asset beyond this level, then you'll have to pay more, something like that. Okay, amounts expected to be payable under any residual value guarantees. Okay, what will happen? Okay, let's say, I do not know if you knew the earlier standard, we had something called as finance lease and operating lease. Okay, maybe a little bit background about that. In the older standard, we had something called as operating lease and finance lease. Okay, so here, operating lease was a general rent agreement. That means, let's say it could be for 3 years, it could be for 5 years. Okay, wherein the asset can be used for 20 years, 50 years. It could be property, land and property, or it could be any other machine and all. Right? Let's say heavy equipment, this cranes, or in your case, this oil exploration, all these assets, okay, which are used to drill. Now they may be, many times they are leased. Okay,
Yes.
Company doesn't buy. Okay, let's say if it is a new company or they want to explore a new new region, right? They may not buy the asset, they may rent it out. There will be
Yes.
equipment companies. For example, we have a company called Caterpillar, okay, which lends cranes and all.
Yes.
So these are general rent agreements where you will use the asset for few years, use the asset for some time, and then return the asset. Okay, the rental amount will be very less. Will be very less compared to the cost of the asset. Rental amount will be very less compared to the cost of the asset. But so this is a generic rent agreement. This finance lease is more of a, but generally more of a substance over a form. Have you heard of this substance over form? What would have happened is, or it was a backdoor entry basically. Backdoor entry for loaning and purchasing. So if I take a loan and buy the asset, then what I would have done? I would have shown a loan, and I should.
And then asset.
But what I would do is, instead of doing this, I'll go to a vendor. I'll tell him that, boss, you buy the asset, okay, and we'll enter into a agreement. Agreement is for 15 years, okay, which is generally the, let's say, life of the asset. Okay, rent, I will pay monthly or yearly. Rental amount such that it is such that
the cost of the asset,
the present value of all
payments
is more or less equal to the fair value of the asset. Okay, agreement mentions transfer of ownership
at the end of the period.
So what happens? That means this is substance over form, right? What the form? The form is asset is owned by someone else. I am only taking on rent. But effectively, what is happening? Agreement is such that you are going to use the asset for the entire life. Rental amount is such that you are paying him the entire cost of the asset.
Yes.
Right. And at the end of the term, the ownership will come to you. Right. That means this is a finance lease, meaning your lease is being financed. Right. So what happened when in the older standard we had operating lease? So if it was operating lease, then you can normal accounting. Okay, normal accounting. If it is finance lease, then you will follow the lease accounting, where you will show lease assets and lease liability. Okay. Now in IFRS 16, what happens? There is no concept of operating lease or finance lease. Everything is finance lease.
Finance lease. Okay.
Everything is finance lease now. Why? Okay, except for smaller transactions where the agreement is less than 1 year.
1 year.
If the agreement is less than 1 year, then there is no point in showing as finance lease or and all. Why? Because the agreement is going to get over. Otherwise, all other arrangements are shown as finance lease. That means you have to show right of use asset and liability. Okay. So what happens if so you have to look at it practically. In any lease arrangement, there can be payment at the beginning, right? Then there could be, because I'm getting an option to purchase the asset, right? I may have to pay additional amount, so that amount also has to be included, right? Any other penalties. So any of these things is all these things should be included in calculating the present value of the lease liabilities. Okay, this is the point. So exam question could be on this termination penalty. Okay, exam question could be on termination penalty, residual value guarantee. Okay, the examination could be on this. Discount rate should be the rate implicit in the lease. Okay, basically cost of capital, the rate of which you could borrow the funds to purchase a similar asset. Right? So this is the rate which you are going to discount the cash flows. Right? So this is about the liability. What will be the asset? Go through that.
Okay. So it is same as the lease liability. And the second point, whatever the payments which we are making, say for example, advance payments, if that is also been recognized as ROU.
Yes, ROU. Basically,
Okay.
any amount of the initial measurement of the lease liability, basically whatever we have, okay, and any payments that we made in advance that will also come, any other cost, okay,
Yeah.
cost of removing or dismantling the underlying asset. If you remember, we saw this last week in IAS 16,
IS 16. Yeah.
right? So same thing.
Okay.
That will also cover. And what will come as lease term. Okay. So in terms of calculation, I think you can go through this. Okay, it will not be a big challenge. Okay. Then the subsequent measurement is basically you are charging the interest cost and all.
Yeah. Yeah.
Okay. And how do you calculate the depreciation? Basically, if ownership of the asset transfers to the lessee at the end of the lease term, then it should be charged over the asset's remaining useful life or over the lease term.
Okay, whichever is like lower, that only we will consider. Right?
No, whichever generally, basically that that is lease that will come. That will fall here, right? By default, it is whichever is lower actually. Okay, you see, depreciation is charged over the short term of useful life and lease term.
Unleased term. Okay.
Okay, so this is about the calculation. You see now, basically I said, right, then it will, once right of use asset becomes, then you will follow IAS 16. So they are giving like an instance, if it belongs to a class of property, okay, that is measured using revaluation model, then you will apply IAS 16 to all right of use assets.
Okay.
Right, you can revalue ROU and all those things. Okay. So can we look at this?
Yes.
Crane. Okay.
Yeah, it's a crane. So it comes from non-lease component separately from leases. If contract separate, it has been
So okay, one good example to give is I think there is one company called now Caterpillar is the manufacturer of these equipments. Okay, GMM Co is more of a broker, basically. Okay, wherein it will help the clients to identify which product to be used. Okay, which of the products to be used. So all these equipments can be leased, basically. Caterpillar is like the company which manufactures this. Okay, and this GMM Co is basically
the intermediary, maybe the
intermediary. Okay, suggesting as to which equipment you can use. Okay, so when I take these equipments on lease, okay, I will have to follow lease accounting.
Yes.
Mostly cranes only. Mostly cranes. On this stuff.
Okay. I think the contract is for the cranes. The total lease contract they've had for 180, and every year they'll be paying 60. Here they're insisting on that non-lease components separately from the leases. So they're telling that the maintenance services for that standalone price is around 40. So that they want to separate that 40 and 160 both. They want to show it differently. But the contract is for maintaining the cranes and using the cranes, right? We cannot.
Into a contract to lease a crane for 3 years.
Yeah.
Right. The contract is to lease a crane for 3 years. Okay. Agrees to maintain the crane during the 3 years period. Total cost is 180,000.
180. Yes.
So now, if the contract separately, it has been determined that the standalone price for the lease of the crane is 160, and standalone price for the maintenance service is 40,000. Right. So now this maintenance service is not an ROU. Let us understand.
Yeah.
Right. So then it has to be
Like a normal P&L expenditure only.
Okay. So that means this 180 includes this maintenance service, right?
Yes.
So how will you account for it? So that means 200,000 you have got how much? 10% discount you have got. That's all.
Yes.
Right. So this will be 160 will become 154,
and
40 will become 36,000.
36.
So 154 divided by how much? 3.
3 years.
Right. So like that only. So let us see the solution. And 54 divided by 3 is how much?
154.
48, 154, 160, 160 divided by 10%, 16, sorry, 144, not 154. 10% discount they are getting, right?
Yes, 48.
200,000. So 160, 10% on 160 is 144.
144.
So 144 divided by 3 is 48.
48.
So lease payment is 48. Maintenance is 12,000. So this will go in P&L.
Yeah. That 48,000.
48,000
is a repayment.
You'll calculate the present value of that.
Yeah.
You'll calculate the present value of that 48,000.
Based on the discount rate of 5%.
Which is 137.15. Okay. So do you know how to calculate this discount rates and all? Any chance?
That PV, we have a formula no, in Excel.
Okay. So Excel. Okay. In your exam, you cannot use these formulas.
Yes.
Okay. As far as I know in exam, okay, after they have introduced computer based, okay, you cannot use that formula, right?
Okay.
The easier approach, for example, here we are talking about 1.5, right? 1.05.
1.05.
1.05 basically 48,000 divided by 1.05, the whole
to the power of 3.
Power 3. Or the discount factor you can calculate like this.
Okay.
This is a discount factor. Okay. This is basically third year.
Yeah.
Okay, third year. Similarly, you will calculate
second year, first year. Okay.
So you can calculate, and then we have a annuity factor formula also. Okay. Annuity factor. I don't remember the formula. And it becomes very, very easy. Just give me a second. I will tell you right away. This one.
PV present value is equal to by
1 minus. Okay, so it looks complicated, but it's not that complicated. 1 plus R.
Okay. Rate of discount.
The whole power minus N.
Okay.
Okay.
Again by R.
Divided by R.
Okay.
This is required only when we are doing manually. If you can use Excel, then it is not required. And the entire thing will be 1 minus. Okay. So basically, power minus n means what I can do? I can bring this 1 plus r
Exponential down.
1 divided by 1.05, right? Whole power 3, right? This entire thing has to be divided by
0.05,
right? Entire thing divided by 1 minus 20. No, then this will be incorrect. Or it will be, okay, let us look at this, is equal to 1 minus this entire thing divided by 0.05. Yeah. Let me get the formula. I will look into it and I will come back.
Yeah.
Okay. The 1 minus 1 plus r the whole power 1 minus this is the formula. So what I have to do? 1 minus
1 plus
1 plus r over n. This is what we did, right? 1 divided by 1.05. Okay, 1 minus.
If is power to the power to is at minus, then it will be like if it is minus 3, then it will become 1 by 3, right? Not to the plus power of 3.
I am bringing it down, right?
Down.
So, okay, let me. Okay, I will look into this. So basically, okay, there is a simple formula wherein you can get this
present value of
instead of doing this 3 to 1, okay, you will get the annuity factor that you can multiply with that 48,000.
Okay.
Because in exam it will become easier. Otherwise, also this will not take time. Anyways, you will have access to Excel, right? If you have to do calculation, then you can quickly do this also. 48,000, 48,000, 48,000. Discounting factor, okay, equal to 1 by 1.05, right? Then this divided by 1.05, this divided by 1.05. Like this also we can do. So it's not much time, but you do have a practice. Okay, it's important because in exam we should be able to do it quickly.
Yeah.
Okay, so this point is not there in skill level. Which point? This point.
Separating components.
Still here, everything else is there in skill level. Okay, the basics, like what should be the asset, what should be the liability. Okay, all the things are there in the skill level, but they don't test on the nitty-gritties. You have to go through the nitty-gritty. Recently, one of my earlier professional level student, right? Suddenly one day evening he messaged, giving some screenshot, telling, "Sir, the answer for lease accounting." He's sitting in some interview. They have told him to take some test online. Okay, has taken the screenshot of all the lease related questions and is sending to me. Okay, so only that entire interview was on lease accounting. Maybe he is attending an interview with a company which is concerned mainly on leases. Okay, and in the interview they're asking like basic questions about which of the following you will include in the cost of the asset. Where one of the points you have to select. So that way it becomes very, very useful. Okay, separating components we've covered. Then reassessing the lease liability using basically if there is any changes, then how do you go about accounting for it? Okay, like lease term changes or the payment terms changes. Instead of 48,000, you're supposed to pay 50,000. Then what happens? So how do you account? Very simple. Basically, you have to restate the liability, right? And again, corresponding impacted. Okay. Then
Okay.
short-term leases. Okay. So short-term leases means very simple. Then
Within 12 months.
for it, like say all these computers, okay,
Mm.
or items of furniture, so you can simply show the rental amount in P&L.
Ah.
Okay, so that is about it. Then lease disclosure. Okay, disclosure requirements. So disclosure requirements also, okay, you'll have to be very clear. Basically, see that if the question is asking, show the like we saw this other question, right? Where is it? Describe how the above transaction should be accounted for. Okay, in the financial statements here, disclosure requirement also you have to write. Okay, as to what is the disclosure requirement, two lines, not more than that.
Okay.
Right? Here they are talking about so many things in disclosure. You don't have to mention like okay,
All points.
all the points, but a few points, right? Like it should also be disclosed in the notes to accounts. Like okay, what are the each of the components? Like what, for example, in IS 28, IS 21, which are all the items we are calculating the FX loss. Okay, or where have you posted the FX loss in the P&L? Disclosure relating to that.
Okay.
Okay, and as far as IFRS 16 is concerned, you have to give all the details in disclosure. Like how have you calculated ROU, the depreciation, the interest, okay, everything, whatever is the flow of IFRS 16 treatment, that you have to tell in the disclosure, telling that all these things you have to show.
Sure.
Okay, now what we have seen is lessee accounting.
Yes.
Okay, what we have seen is lessee accounting. Like when I'm taking the asset on the lease, how do I go about accounting for it? Okay.
Yes.
Now then there is lessor accounting also is there. In lessor accounting, what they have done is there's an interesting point. From IAS 16 to IFRS 16, whatever the changes were done was mainly concerning lessee accounting.
Yes.
Right?
Yes.
Earlier I was taking some asset on lease. Okay. Even though it was not a lease, it was a loan arrangement. I showed it as lease. So to curb all that, lessee accounting was impacted. But lessor accounting, they have kept it same as IAS 16. Okay, sorry, IAS 17 is the older standard. Okay, where they are giving both the choice, where okay, finance lease and operating lease are continued. Okay, so like what is a finance lease is like whatever we have just discussed before, right? We discussed some points, right? Like finance lease.
Yeah.
Right, like these are
Substance over form.
Substance over form. Okay, substance over form is a I do not know. Have you heard about this phrase term? Substance over form.
No.
Okay, basically substance over form is nothing but okay. This is part of the framework. Okay, where accounting standards require you to follow substance over form. So that's lease. When I'm taking an asset on lease, right, wherein I'm entering into an arrangement with someone telling that boss, you buy the asset and give it to me, right? The form, the legal form is he's owning the asset. I'm not owning the asset.
Yes.
Right? He's owning the asset, the legal form. But what is the substance? In essence, the substance is I'm using the asset, I'm controlling the asset. In essence, as if it is I'm owning the asset, not him. Right? So the accounting standard says, or the accounting requirement, the GAAP generally accepted accounting principles, right? Say that we should have substance over form. We should follow substance over form. We should follow what is the substance of the transaction. Just to gimmick the books, right? Just to cook the books, you have entered into some legal arrangements. Legal form could be something else, but what is the substance? For example, we will see this in IFRS 9, preference shares. Right? Now, preference shares, when I'm issuing preference shares, the difference between preference shares and equity shares, what is the difference?
It will be given mainly to the preferred people in like preferred shareholders, or so few specified peoples.
Basically, preference shares is you'll be given preference over equity shares at the time of liquidation.
Yeah.
No.
It will be paid before. Yeah.
How many companies go into liquidation? Not many, right?
Many.
Right. Point one. Point two, the difference, operational differences, preference shareholders get a dividend, fixed dividend.
Yes.
Right? Equity shareholders don't get a dividend. So the preference shares in all essence, right? Equity shareholders have voting rights. Preference shares may not have voting rights. Okay. So in all essence, preference shares is nothing but a loan, liability, bond.
Yes.
Why? Because preference shareholders get that interest, fixed amount, okay, which is called as dividend. But effectively, it is you are paying them a fixed income, right? So what IFRS says is under IFRS 9, if preference shares all more or less, right, if they're getting equal amount of dividend every year, a fixed rate of dividend, that means they are more or less like a debt. So classification, you should show it as debt instead of preference shares. Instead of equity, you should show it as debt. Substance or in essence, even though the legal form is they are equity, they are shareholders.
Preference. Yeah. Yeah.
They are shareholders. But what is the substance? They are more or less like a debt. Why? You are paying dividend in terms of interest. Instead of interest, you are paying dividend. Right? You are just renaming them. Okay. So the classification in the balance sheet, right? What they are telling, show preference shares as debt instead of equity. So that is basically substance over form. Okay. So yeah. So how ownership is transferred? Probably finance lease. If one or more of the following apply, ownership is transferred to the lessee. Right. Lease term is for the major part of the asset's economic life. So basically, finance lease is a lease where they are telling ultimately you will get the ownership. How? Either you have the option to purchase the asset, okay, or you are using the asset for the major life. Okay. The present value of the lease payments, okay, are substantially the fair value of the lease asset. Like this, the term conditions that, okay, it becomes a finance lease. It becomes the ownership is transferred. Okay, so a lessor must classify its lease as finance lease or operating lease. So what will happen? Lessor, from a lessor perspective, if he is classifying as finance lease, then what will happen is that means the asset basically he has given an asset to someone, finance lease. To say someone will get the ownership at the end.
Yeah.
What he should do is he should de-recognize the asset in its books. Okay, he should stop providing depreciation. Then he should show as lease receivables. Instead of PPE asset, he should show lease receivables. For example, as a lessee, what I'm showing lease liability, right?
Yes.
He should show lease receivables.
In the asset side.
If it is finance lease. So finance lease, initial look at this.
Okay. It is shown as an receivable.
Receivable.
Yeah.
Why? Because the other party is showing as an asset, right?
Asset. Yes. Yes.
So same thing. Whatever the right of use asset we had,
same thing here.
Subsequent treatment, carrying amount of the lease receivable is increased by finance income. Basically, what will happen? Lease liability, what will happen? Lease
they will make a payment.
You will amortize, will keep making a payment and all those things.
Yeah.
So here the opposite side.
Yeah, it will be on the income side. It will come as an income to us from them. And it will be automatically be reduced the carrying amount of the lease receivables.
Yes, because you are getting the payment.
Yeah.
So operating lease, very straightforward, rental income. Okay, rental income basically.
Okay. And since it's a rental income, it will be normal asset of the particular lessor, and it will be depreciated over the time, and all this IAS 16 will apply to that as a PPE.
Yes.
Okay.
You see now profit or loss arising on the sale. Why? Because when I'm giving on, I'm carrying the asset in my books, carrying amount is there, but I'm suddenly leasing out to someone on a finance lease basis, right? So there will be definitely a difference, profit or loss that is arising on the sale.
Yes.
right? Why? Because carrying amount was something, but the lease receivable amount is going to be calculated as the present value of all
Present
this.
value of all. Yeah.
There will be a difference. So that gain or loss should be shown in the P&L.
Yes. P&L. Yeah. Wait and lease.
Okay, read this. Conceptual framework is something I will discuss separately, but if read this, you'll get an idea.
Okay, if the particular entity, the leasing company, transfer the asset to the lessor and then leases it back.
No, I'm talking about this one. This one.
Okay, sorry. Thank you.
So you understand the background now, like
Why there is a change only in the leases book
Lessee
and not in the lessor?
lesser account. Okay.
Yeah.
So sale and lease back. Do we know what is this?
I didn't understand the term. Even I saw this in the video, but I didn't understand it properly.
Sale and lease back. Huh? Okay.
Yeah.
So basically, what happens? I'm having an asset. Okay, I'm having an asset in my books. Asset in the balance sheet. I'm owning the asset. Okay. This asset is mine.
Mine. Yeah.
I need funds. What I do is I sell the asset. Okay, get the funds. Okay, then borrow the asset. Release.
Okay.
So essentially, what you have done, you have sold
The asset.
and you have leased it back.
Yes.
Sold and you have leased it back. Right? So what will happen when you sell the asset? You will credit the P&L.
Yes.
Right? If there is any gain or
Loss.
if there is a loss. Right? So essentially, what the standard case is, this is nothing but you are taking a loan by mortgaging the asset.
Okay.
You have not sold the asset. Correct? You have not sold the asset. What happened? You had the asset. Instead of mortgaging it in the bank or to someone and continuing to use the asset, right? What you have done, you have sold the asset so that you will take it away from the books of accounts, right? And then
lease.
you have leased. That means you are continuing to use the asset.
Yes.
Right? The asset is in your control. So in that case, what the standard says is, then it should not be shown as a sale of the asset, right? You will continue to show the asset as ROU and lease liability.
Okay. So the sale related transaction, it will not happen.
Reversed fully.
Okay.
Right? You will not show P&L fully. Right? Now, again, there are some depending upon the terms. Okay, what are the terms? Basically, if it is in the nature of finance lease, meaning to say you have sold and you have again taken entire control of the asset, right? The lease arrangement is such that 15 years I will use, 20 years I will use, right? In that case, you will not have any gain or loss. But if, let's say, you have sold the asset and then you have told, see, I will get into an arrangement for 1 year. I need the asset for 1 year. Right? In that case, it may not be fully an ROU, right? Only to that extent, 1 year only you are getting the rights.
Yes.
Right? So accordingly, you will show the P&L also. You will show the gain in the P&L also, and ROU will also you will show accordingly. So that is a calculation that we are talking about.
Okay.
Okay. For example, basically that is what transactions at fair value and okay. So you see, look at this. When is the transfer? Okay. Basically, we are talking about entity transfers an asset to another entity, then leases it back. Should it be shown as sale or should it not be shown as a sale? So they're telling, let's read this first. Transfer is a sale.
Sale. Okay.
If the transfer is a sale, right? That means it is actually a sale, genuinely a sale. Right now, okay, if the genuinely it is a sale, then you are exempt from more or less from IFRS 16 requirements. Okay, you only have to show to the extent of like how much you are going to use the asset. Okay, so this means that the seller or lessee, right, will recognize a profit or loss based only on the rights transferred to the buyer. Okay, now transfer. Now read this. Transfer is not a sale. Who is the seller? I sold the asset and I took it back. So I am a lessee. Seller, lessee.
Lessee. The seller still recognize the transferred asset in his books.
This is not generally a sale transaction. We are trying to circumvent the law. That means we are trying to just put the books. Okay. Just the objective was only to raise funds. In that case, you will have to show that as a loan. Seller lessee continues to recognize the transferred asset. Will recognize
under IFRS 16. The same thing it will apply.
Okay. In simple terms, the transfer proceeds are treated as a loan. Actually, that is what I wanted to do. I wanted to raise money by mortgaging the loan, mortgaging the asset. Right? So instead of doing that, I sold the asset, then I took a lease. Right? So IFRS 16 done. It says nothing doing, keep quiet. You have taken a loan, show it as a loan. Okay, and that will be treated as part of your debt, non-current liabilities and current liabilities and all those things. Okay, that where transfer is not a sale. So this is simple actually. Transfer is not a sale. Very simple. You will recognize a financial liability equal to the transfer proceeds.
Yes.
Right. Whatever you were, so you will not recognize any gain or loss and all. Okay. Why? Because the asset is not sold. So what will happen in an exam scenario? They will say that company sold the asset, recognized the gain so much, and all those things. Right. And it appears that it is not a sale. Then you have to explain it is not a sale according to IFRS 16. In which case you cannot de-recognize the asset. You have to continue to recognize the asset. You have to reverse the gain or loss that you have reported. And you have to show and you have to recognize the financial liability. Right? Where transfer is a sale. The transfer does qualify as a sale. It means that the seller lessee means who I only sold initially and I became a lessee. I will recognize profit or loss based only on the rights transferred to the buyer lessor. Okay. So how much rights have been transferred? So that we will see. We will work out a question based on that. Okay. So let us. Can we read this? Yeah.
Okay, 3 million. That's it. Sale liability is notification of notification. Okay. Annual yes. Okay, the company is selling one of its machinery to college for 3 million. The asset has a carrying amount of 1.2 million. And the sale and since it's the sale is set to be like the transfer is set to be a sale.
In accordance with IFRS 15.
Yes, yes.
So that reference is only given here.
Yeah.
Basically, for this purpose, entities must apply IFRS 15.
Yes.
To decide whether a performance obligation has been satisfied.
Satisfied. Yes.
Right. So that is what they are telling. They are already telling you that a performance obligation is satisfied. So this
satisfied.
This is a sale. That means you will have to go through like this.
Yes. So then the 1.8 billion is the gain what we have got.
But
on the sale.
We will not show entire 1.8 million as gain. Okay, so how to do that is like, okay, let us look at this.
Yeah, based on the ROE asset which we are going to recognize.
Right? So first thing is, okay, my book value. Book value is how much?
1.2 million.
1,200. Okay, and sold for
3,000.
Sold for 3,000. Okay, now let us look at the present value of these amounts. Okay, 500,000 are due at the end of each year. Okay, so relative to present value, 10%, number of periods,
5 years, 500.
500. Future value
1.9.
Future value is 0.
Okay.
They are already telling present value of the lease payments is 1.
Okay.
They are already telling the present value is 1.9 million.
1.9 million. Okay.
And the remaining useful life of the machine is much greater than the lease term.
Okay.
Okay, so
then it means it's not a financing lease.
That is clear because it is a sale.
Sale.
Right, it is a sale, and also the remaining useful life of the machine is much greater.
Much more higher. Yeah.
Okay, much greater. So it will not be a financing lease. So that means you will not continue to show the asset at 1,200. Right? Okay. So how do we do this calculation? Okay. So 1,900. If I have to recognize this asset, why? Because I have taken the asset on lease. Right?
Yes.
So that means if I have to recognize ROU, I will show the ROU at 1,900.
Yes.
Okay. Now in terms of cash, okay, cash that has come. Cash that has come is 3,000. How do we account for this cash? Is a question. Right. So bank account, you will debit 3,000. Right. You will credit the
ROU.
CP.
Okay.
Book value was 1,200.
1,200.
Okay. And you have to debit ROU, right?
Yes.
ROU.
Yes.
Debit. Okay, we'll debit ROU, let's say
1,900.
1,900. Then and you have to create a liability also.
Yeah, to the extent of 1,900.
This liability to the extent of 1,900. Let us look at what the standard says. Lessor accounting requirements. proportion of the previous carrying amount that relates to the rights retained. 1200 divided by 1900. That is the proportion.
Yes.
Okay. So now lease liability, how much? For example, in this case, what they said, if it is not a sale, financial liability equal to the transfer proceeds.
Sales proceeds. Yeah.
But here they are not talking about it. In which case,
Yes.
In which case, see how the logic is very simple. The logic is I have to keep paying this 500,000.
Yes.
That means I have to have that liability of 1900. So, okay, let us assume. So now, how do we show the P&L gain or loss? Should I show 1800 or should I show something else? Right. So what they are telling here, because this is the most complicated part as far as this standard is concerned, I'll tell you. This means that the seller lessee will recognize a profit or loss based on the right transferred. Okay. How much is the right transferred to the buyer lessor? What is the fair value of the asset?
3 million.
3 million. Fair value of the asset is 3 million. Okay. How much you are transferring for? What is the present value for which you are transferring?
Present value, book value is 1.2 million. Present value is 1.9 million.
1900. So that means one way of looking at it is, okay, something which has a value of 3000, you are using it for 1.9. 63% of the rights have been
transferred.
Retained. Okay. I will recognize based only on the rights transferred to the buyer. Lessor. Who is the buyer lessor? The other party. I sold the asset to him, right? How much I am retaining? I am getting rights worth 1900.
Yes.
Right? The present value of the asset that I am using is 1900. The value is 3000. So the right that I am using is 63%. So the right that is transferred is 37%.
37%.
So in that case, I may recognize only 37% of the gain. So 1800 into
37
into this 36%, let's say 660 balance out of 1800. What is the balance? Balance of 1800. Where will we show? Are you getting first the meaning of this point? The meaning of this point is the seller lessee must measure the right of use asset as the proportion of the previous carrying amount that relates to the rights retained. So 2 points: rights retained and rights transferred. Okay. How much is the rights retained? 63%.
63%.
Rights retained and rights transferred. So 63% is a right retained. In that case, the P&L is only 660. So balance I am having 11,140. So in which case, and ROU also needs to be adjusted. Are you getting it? So how do I? There are multiple ways of doing it. So one is they're telling you measure ROU as a
proportion of the carrying amount.
So ROU to be shown at this rate.
The 1900 at 63%. Okay.
Be able to first this is important to understand. Okay. Why? Because I'm not going to use the entire asset.
Yeah.
To some extent I'm going to use. But this is a rights rating. So only to this extent I'm going to use the asset. So my ROU should also be around this only. Okay. So let us see how we are calculating the answer. This question is there in skill level also, but in skill level they have not tested much.
Okay.
Okay, so let me check one sec. Mhm. So if you see, everything is what we've done here, 660. So instead of ROU being 1900, what they've done is
1900 into that 63%. Okay.
So ROU will be 760 and P&L will be 660. Lease liability 1900. So if you
1900.
see, what we need to calculate here is basically only these two things. This is known. Lease liability will be 1900. That is known.
Yeah.
Right. PP you will remove asset. The book
Asset.
value you will remove. Right.
Yeah.
What needs to be calculated is only these two things.
P&L and ROE. Yeah.
Right of use asset is only 760. How are we calculating? 1900. Okay, minus the P&L that is accounted for. So if you look at this, basically,
Okay.
so rights retained is this 1.9 million divided by 3 million, right? So this calculation is very, very important. So what I will suggest is in your book, okay, because in book they are not giving this formula directly, right? In the book, okay, this is what page number 202. Here, right? You can here you can write with in your book itself. You can make a note as to how you will calculate this. Okay, so proportion of this 1.9 divided by 3 is 1.9 is ROU. Sorry, present value of lease payment divided by the fair value. So 63% of the rights retained, that multiplied by the book value. So
book value
1200 into book value multiplied by rights retained, right? So 1200 into the rights retained, and this should be book value into the rights transfer. So gain into the rights transfer. This is the only thing that we need to calculate as far as this particular question is concerned. The things are direct, like straight away we know. So basically, this is an example where the transfer is a sale.
Sale.
Okay. Should understand it. Yeah. So this is the ultimately they're talking about. So you can go through this. Okay. So some variants. Okay. So that is about your lease accounting. Okay. So few questions we have worked out. Few questions you can work out at your. Okay. If there is any doubt, you can let me know. Anything like, is it clear? Like whatever we discussed today?
Yes. Yes.
Okay. All right. So again, we will catch up next week. Again with mostly Saturday same time, evening 6 o'clock.
Okay. Okay.
Okay. So I hope you are taking out time to practice.
Yes.
Right? Because what will happen is, I think we are in 7th or 8th chapter.
Yes.
Okay. So like quickly we'll be able to complete the syllabus. Maximum
Hmm.
1 month's time. Okay, maybe by April 15th we should be able to complete the syllabus.
Hmm.
Okay. Then maybe few sessions for practice and all those things.
Okay.
Yes. It will be effective only if you practice at your end.
Yeah,
Okay.
yeah, sure.
Okay, very good. Okay, fine. Thank you. We'll catch up.
Yeah, thank you. Bye.